The unemployment rate has dropped fairly sharply in the month of December. It's fallen from 4.3% in November to 4.1% in the month of December. The broad expectation was for the jobless rate to actually edge up in the month of December to 4.4%, so it's certainly beaten market expectations. The reason the jobless rate has fallen is that we saw 65,200 positions created in the month of December. And the participation rate actually held steady. It didn't increase. So the amount of people in work or looking for work stayed the same as in November. So that increase in jobs and people employed presumably has helped drive the unemployment rate down. It does look on my initial readings as though the bulk of the jobs created were actually full-time. So that reverses a little bit of what we saw in November, where the bulk of the jobs created were actually part-time. It is worth noting, though, that this is a notoriously volatile series month to month, so economists will be looking for the broad trend. But this has certainly gone against expectations across the board that the unemployment rate was set to stay where it was or rise slightly. And in fact, the RBA itself, in its most recent November forecast, had the unemployment rate for the December quarter sitting at about 4.4%. So this is certainly a lower unemployment rate than most were expecting. Dr. Brendan Rynne is the chief economist at KPMG, and he is standing by for some analysis. Brendan Rynne, thank you so much. Is this a surprise number for you?
Yes, it was. So it's quite significantly stronger than what we had anticipated. Market consensus had new employment growth of about 30,000. And so that would have, with the normal or keeping the participation rate at the same level and the sort of standard level of population growth, that would have kept the unemployment rate at 4.3%. The fact that we've had double that amount of new employment, particularly as you just mentioned, a lot of that is in full-time employment, so 54,000 new full-time jobs, shows a much stronger labour market than any of us had anticipated. December can be a bit of a funny month with regards to labour market data, and often you'll see that December employment growth is actually part-time or casual. The fact that we've seen much stronger employment growth and that it's been full-time does show that strength within the Australian economy is being maintained.
And I mean, there were broad expectations, as we've both said, that this would be a fairly benign number, but given the quite steep fall in the unemployment rate, is this now material for the RBA heading into the February meeting just a week and a half away?
Not really. It may be material if it swung the other way. But as you mentioned, this is a notoriously volatile series. I think the Reserve Bank had pretty much a strong understanding that the labour market wasn't in fact a problem, either positive or negative. The fact that it's still sort of sitting around full employment, I think just sort of ticks that box to understand that there's no real underlying labour market problems. So, I think that that's really not the issue for the Reserve Bank. Fundamentally, the Reserve Bank is being focused on inflation. We've had the November inflation data out earlier the month that showed it dropped at a headline level from 3.8 to 3.4%. And we have the December quarter CPI coming out in next week, I think on the 28th, and the Reserve Bank meetings on the 2nd and 3rd of February. So I think that the inflation data is going to be much more important for the Reserve Bank.
Well, markets like to jump on any number that's printed, and I was just looking at the market bets for a rate hike in February. They have increased from 29% chance of a hike now to about 44%. There are also a number of bank economists predicting a hike in February. What's your view?
My view is that the Reserve Bank should just sit on its hands still. I mean, one of the things to recognise with the inflation data is that it is very volatile at the moment because of a number of factors, of which one of those is the treatment of those energy rebates that are now getting wound out. We've calculated our own inflation series where we've in fact ignored those electricity rebates, and that headline inflation, instead of being 3.4%, is in fact down to 3.2%. And it is continuing to trend down. In October, the headline number was 3.8 and our series was at 3.3. So it is trending in the right direction. We are only marginally above the top of the target band. At 3.6%, the cash rate's still contractionary, slightly contractionary. And given the global uncertainty of what's happening out there still with regards to trade and tariffs, it does seem prudent that the Reserve Bank just adopt a wait and see approach.